The trade that hurts you most is often not the one you lose on. It is the one you never decided how much you were willing to lose on. You enter because the setup looks clean, the momentum is convincing, and the reward appears obvious. Then price moves against you, and suddenly your risk is no longer a number. It becomes a negotiation. That is where a manageable trade begins turning into a dangerous one. The market does not punish optimism. It punishes undefined exposure. When you focus first on what you might make, you naturally give more weight to evidence that supports the trade and less weight to evidence that threatens it. A failed breakout becomes one more test. Weak follow-through becomes temporary hesitation. The longer you defend the position, the more your original analysis is replaced by your need to be right. So before judging opportunity, judge vulnerability. Where is the trade objectively wrong? How much movement against you would change the structure rather than merely make you uncomfortable? Notice the difference. Price fluctuation is normal. Invalidation is information. Watch your own behavior around that boundary. If you widen risk only after price moves against you, the market has already changed the decision you claimed to make beforehand. If your position size makes normal volatility feel intolerable, the problem may not be the setup at all. Reward matters, of course, but the order in which you think about reward and risk changes how you read everything that follows, and that order exposes several mistakes traders rarely notice until capital is already under pressure. A trade usually becomes dangerous before the loss becomes large. The first warning is often not the price movement itself, but the moment you begin changing the meaning of that movement. You entered for a reason. Perhaps price broke a level, held support, or showed strength where strength was required. That reason created the trade. But once you are in it, a strange temptation appears. Evidence that would have kept you out before entry suddenly becomes acceptable after entry. That is how a clear idea turns into a personal argument with the market. Before you enter, weakness is information. After you enter, weakness can become something you explain away. A failed breakout becomes temporary hesitation. A broken level becomes noise. Another adverse move becomes one more chance for the market to recover. Notice what has happened. The trade has not only changed, your standard of proof has changed with it. The important question is not, how much pain can I tolerate? It is, what must remain true for this trade to deserve my capital? Those are different questions. Pain is personal. Invalidation belongs to the market structure that justified the position. If the condition that created the trade disappears, staying involved requires a new reason. And if that new reason only appeared after the trade moved against you, examine it carefully. Because the next danger begins when a trader is no longer protecting the original idea, but protecting his need for the idea to survive. A trade can be perfectly reasonable and still be impossible for you to manage well if the position is too large. The danger appears in ordinary movement. A small fluctuation that should mean nothing begins to feel important because too much money is attached to it. You watch every tick. You react to every pause. What should be observation becomes emotional surveillance. Size changes the way you see price. With modest exposure, you can allow the market to behave naturally. With excessive exposure, the same movement feels like a threat that demands action. You may exit a sound position simply to escape discomfort, then watch the original idea develop without you. The analysis was not necessarily wrong. The pressure created by the size made disciplined execution difficult. That is why position size should not reflect how strongly you want the trade to work. Desire has no useful place in that calculation. A trader who increases exposure because an opportunity feels exciting is quietly making his emotional conviction more expensive. Before entering, imagine the position moving normally against you without giving any meaningful information. Can you still observe it calmly? Can you resist the urge to interfere simply because the numbers on the screen are uncomfortable? If the answer changes when the size changes, you have learned something important. The market may be offering the same trade, but you are no longer bringing the same judgment to it. And that raises a harder question. Should every attractive opportunity be allowed to become a trade at all? Some trades should be rejected before you ever ask what they might pay. The mistake is letting the possible reward speak first. Once you picture the upside, flaws begin to look negotiable. Poor structure becomes good enough. Unclear conditions become worth the chance. You stop examining the trade and start building a case for taking it. That reversal matters. A sound decision begins by asking whether the trade is acceptable on its own terms. Is the market behaving clearly enough to read? Is there enough order in the movement to make the opportunity understandable? Are you entering a situation where your decisions can remain deliberate, or one where confusion is already part of the setup? The larger the imagined payoff, the easier it becomes to excuse what would normally make you walk away. That is the hidden cost of focusing on reward too early. It changes your standards before any money is committed. So build disqualifying conditions into your thinking, not reasons to dislike a trade, reasons to refuse it. If one of those conditions is present, the potential upside should not be allowed to reopen the argument. A trader does not need to participate in every promising story the market presents. Sometimes discipline is simply refusing to calculate the prize. But even after a trade passes that first test, another problem remains. A good opportunity can still produce a bad outcome. A good trade does not owe you a good outcome. That is one of the hardest facts to accept because careful analysis creates expectation. You study the conditions, wait for the setup, and make a reasonable decision. Then the trade loses. The temptation is to treat that loss as evidence that the decision itself was wrong. But markets do not work one outcome at a time. A valid idea can fail because uncertainty never disappears. The mistake is not being wrong on a trade. The mistake is believing that being well prepared should remove the possibility of being wrong. That belief quietly changes behavior. When you become too certain, normal failure feels abnormal. You search for explanations that preserve your confidence, or you abandon a sound process because one result offended your expectations. Judge the decision separately from the outcome. Ask whether the trade met the conditions you required before entry. Ask whether the reasoning was sound, based on what was known at the time. Do not let the next price movement rewrite the quality of the original decision. This is where discipline becomes less emotional and more statistical. You stop demanding that each trade prove your judgment, because no single trade can do that. But accepting uncertainty creates another problem. If no favorable setup can promise success, then the size of the possible reward must be examined with much greater care, and not every attractive target deserves to be believed. A trade can look attractive on paper simply because the target was placed far enough away. That is the weakness hidden inside reward to risk calculations. The numbers may be precise, but the assumptions behind them may not be. If you risk 1 unit and aim for 4, the ratio looks impressive. But the market does not care how attractive the arithmetic appears. It only cares whether price has a credible path to that target. This is where traders can fool themselves without realizing it. They choose an entry they already like, then stretch the target until the trade seems justified. The calculation comes last, but it is presented as if it proved the decision. A useful target should come from observable behavior. Where has price reacted before? Is there enough room for the move to develop? Does the structure support the distance you are asking the market to travel? If the target exists mainly because the ratio needs to look better, then the reward is imaginary even though the risk is real. Try reversing the process. Before calculating any ratio, decide where the market itself gives you a reasonable objective. Then compare that objective with what must be risked. You may find that some trades lose their appeal immediately. And once the reward is grounded in reality, another question becomes unavoidable. What happens when you magnify the trade itself faster than the market can justify? Leverage does more than make a loss larger. It can shorten the amount of time you are allowed to be wrong. A market can move against a sound idea before moving in its favor. Without excessive leverage, that movement may remain part of the normal development of the trade. With too much leverage, the same movement can create pressure that demands action before the market has actually settled the question. That changes who controls the decision. You may believe you are waiting for your analysis to prove itself, but your exposure is setting the clock. A temporary adverse move now threatens margin, available capital, or your ability to remain in the position. The trade is no longer being managed only by what price is saying. It is being managed by how long your financing can tolerate what price is doing. This is why leverage should be judged by more than the upside it magnifies. Ask what happens if the market takes longer than expected. What if it moves sharply against you before recovering? Do you still possess the freedom to make a deliberate decision, or have you built a position that will make the decision for you? When leverage removes your ability to wait through ordinary uncertainty, you have surrendered something more valuable than potential profit control over timing. And even when one position leaves you enough room to think, several positions can quietly combine into a risk you never intended to take. 5 positions can look diversified and still amount to one decision. You may own different stocks, different sectors, even different markets. But if all of them depend on the same underlying force, their differences can be cosmetic. A change in interest rates, a shift in risk appetite, weakness in one economic theme, one event can pressure every position at once. That is how hidden concentration forms. The mistake is judging each trade separately. One position may look modest, so may the next, but risk does not always add in a straight line. When several trades respond to the same market driver, losses can arrive together at the exact moment you expected diversification to protect you. Before adding another position, ask what would make the first one fail. Then ask whether the new trade would likely suffer from the same condition. If both depend on the same answer, you may not be adding a new opportunity. You may simply be increasing exposure to an idea you already own. This matters most when markets become stressed, because relationships that seemed loose can suddenly tighten. What looked like several independent bets can begin moving as one. The account may show 5 positions, but the market may see only one assumption. And when that shared assumption breaks, the next danger is not always the loss itself. It is what the trader feels compelled to do after seeing that loss. A loss becomes more dangerous when you begin treating it as money that must be won back. The market does not know what you lost yesterday. The next setup has no obligation to repair the last one. But after a painful loss, the account balance can become a psychological target. You stop asking what the new trade deserves and start asking what it would take to get back to even. That changes the standard of judgment. A trade that would normally look ordinary can suddenly feel necessary. You may demand more from it because the previous result created unfinished business in your mind. The new position is no longer carrying only its own uncertainty. It is carrying the emotional weight of the last one as well. Watch for that shift after a loss. Are you evaluating the next opportunity on its own evidence, or calculating how much it could restore? Would you take the same trade, with the same urgency, if the previous trade had never happened? If the answer is no, then the old loss is still making decisions. The cleanest separation is mental before it is financial. One trade ends, and the next begins without inheriting a debt. Until that separation is restored, even a reasonable opportunity can become a recovery attempt disguised as analysis. And once trading begins to feel necessary, another kind of risk starts to appear. One that has nothing to do with recovering money and everything to do with the need to stay involved. The need to be in a trade can create risk before the trade itself has earned your attention. Inactivity makes some traders restless. A quiet market feels like wasted time, and an empty position feels like missed opportunity. That discomfort creates pressure to find something, anything, that looks tradable. Once participation becomes the goal, standards begin to soften. A setup that would normally be ignored starts to look acceptable. A weak signal receives more importance because you want it to mean something. You are no longer waiting for the market to become clear. You are asking unclear conditions to justify your need for action. That is how overtrading begins without looking reckless. The danger is cumulative. One mediocre trade may do little damage, but repeated exposure to marginal conditions drains attention, patience, and capital. Worse, it trains you to respond to activity rather than quality. The market moves, so you act. The market pauses, so you search harder. Ask yourself what would happen if no valid opportunity appeared today. Could you remain flat without feeling that something had gone wrong? That question matters because waiting is not the absence of trading judgment. Sometimes it is the clearest expression of it. No position means no unnecessary exposure and no need to invent conviction where none exists. But preserving capital by staying out is only one part of the problem. The harder question is what every risk you do take removes from your ability to act later. A large loss does more than reduce capital. It reduces the number of good decisions you are still free to make. That is the part traders often underestimate. Capital is not only money waiting to be multiplied. It is the ability to remain selective. When enough of it is damaged, future opportunities begin to look different because your room to act has narrowed. A trader with adequate reserves can pass on uncertainty, wait for clearer conditions, and approach the next opportunity without desperation. A trader recovering from severe damage may see the same market through a different lens. Good setups can feel too dangerous to take. Ordinary opportunities can feel too small to matter. The loss begins shaping decisions long after the trade itself is gone. So before accepting risk, consider what failure would leave behind. If this trade goes badly, will you still be able to approach the next one with the same patience and freedom? Or would the damage be large enough to alter how you think, what you can tolerate, and which opportunities remain available? This is why preservation is not merely defensive. It protects your future judgment from becoming dependent on one present outcome. You do not know where the next exceptional opportunity will appear. The responsibility is to make sure one ordinary trade does not leave you unable to meet it properly. And sometimes the greatest threat to that discipline arrives not after a loss, but after success begins changing what you believe you can safely risk. A winning streak can make risk feel smaller without making it smaller at all. Success changes perception quietly. After several trades work, you begin trusting your judgment more quickly. Setups that once required patience now receive the benefit of the doubt. You may not think you are becoming careless. You simply feel that you are seeing the market more clearly. That is where standards begin to move. Recent profits can create the illusion that your decisions deserve more freedom. You accept weaker entries, overlook conditions you would have questioned before, or become less demanding about what must be present before you act. The market has not necessarily become easier. Your threshold has become lower. The danger is not confidence. Confidence is useful when it comes from disciplined repetition. The danger begins when favorable outcomes are mistaken for proof that caution is no longer necessary. After a strong run, ask a difficult question before the next trade. Would this opportunity still meet your standards if the previous 5 trades had been losses or had never happened at all? If the answer changes because you feel ahead, then recent success is influencing a decision that should belong to the present setup. Profits can expand the account, but they should not automatically expand your permission to be less selective. And when confidence begins attaching itself to outcomes, another subtle distortion appears. The price you entered at can start carrying far more meaning than the market ever gave it. Your entry price can become the most important number on the screen for one reason only: it belongs to you. Once a trade moves against you, breakeven begins to feel like a destination. A small rebound brings relief. A return near your entry feels like a second chance. Without noticing it, you stop asking what the market is doing and start asking whether it will give your money back. That shift is dangerous because your cost basis has no influence on future price behavior. Suppose price weakens, then recovers halfway toward your entry. If the recovery itself is poor, that weakness matters. But when breakeven becomes the objective, you may ignore it. You hold because you are almost back. Then price turns lower again, and the opportunity to make a fresh decision has passed. Try removing your entry price mentally from the chart. If you had no position, what would the current action mean to you now? Would you still want exposure here, or are you staying only because closing below your entry feels unfinished? The market offers new information continuously. Your purchase price is old information. When old information receives more authority than current behavior, Risk can survive long after the reason for tolerating it has disappeared, and even a perfectly rational exit plan carries another assumption that deserves examination, that the market will actually let you leave where you intend. A stop can define your intention to exit without guaranteeing the price at which you will actually leave. That difference is easy to ignore when markets are moving normally. Price trades through levels, orders are filled, and risk appears measurable. But some events change price too quickly for that neat sequence to survive. Earnings, economic releases, overnight news, or sudden shocks can cause the next available price to appear well beyond the level you planned. The problem is not that the stop failed. The assumption failed. If your entire risk calculation depends on being filled near one exact price, then you are treating a possibility as a certainty. The market can reprice before you are given the chance to act. What looked like a controlled loss on the chart can become something materially larger in execution. So before carrying risk through an event or a closed session, ask a different question. Not, where is my stop? Ask, what happens if there is no trade available near my stop at all? That question forces you to consider the position under conditions you cannot control. If the answer makes the trade unacceptable, then the protection was never the order itself. The protection was recognizing the gap risk before exposure existed. And even when price moves continuously, there is still another assumption hiding inside every exit plan, that enough buyers or sellers will be there when you need them. A position can look easy to exit until the moment everyone wants the same door. Liquidity is often invisible when conditions are calm. The spread is narrow, orders fill quickly, and size seems manageable. That creates confidence. But the market you enter may not be the market you have to exit. When pressure increases, buyers can step away, sellers can crowd the book, and the distance between quoted prices can widen. The risk you calculated from the chart may then become smaller than the risk you actually realize. You intended to sell at one level, but the available market is suddenly somewhere else. This is why execution risk deserves its own judgment. Before entering, notice how the instrument trades, not just where it trades. Watch the spread. Watch how price reacts when volume increases. Notice whether modest orders move the market. Ask whether your position could be reduced without depending on unusually favorable conditions. The important question is not simply, can I get in? It is, what might getting out look like when conditions are worse than they are now? A trade with attractive upside can become poor business if the exit depends on liquidity remaining generous under stress. The market does not promise to provide the same depth when you need it most. And once execution is understood, another form of risk appears inside the trader himself, judging a position by price movements that belong to a completely different time frame. A trade can become confused when the time frame that justified the entry is not the time frame you use to judge it afterward. You may enter because a daily structure is developing, then spend the next hour watching every small fluctuation. A 5-minute pullback begins to feel important, even though it has done nothing to the larger condition you originally traded. The shorter chart creates more movement, and more movement creates more chances to interfere. The opposite mistake is just as revealing. A short-term trade begins to fail, and suddenly you decide it was meant to be held longer. What began as a brief idea becomes a multi-day position, because changing the time frame feels easier than accepting what the original trade is saying. In both cases, the problem is the same. The clock becomes flexible after money is at risk. Before entering, decide which time frame has authority over the trade. What price behavior actually matters. Which movements are expected noise, and which belong to the decision you made. Then judge the position using that same frame unless genuinely new information gives you a reason to reconsider. A time frame is not merely a chart setting. It defines what evidence deserves your attention. And even when you remain faithful to that frame, one deeper question remains, what if the familiar pattern is still there, but the market environment supporting it has changed? A familiar setup can become dangerous when you assume the market around it has not changed. The pattern may look identical to what worked a month ago. The same breakout, the same pullback, the same shape on the chart. But patterns do not operate in isolation. Their meaning depends on the environment carrying them. A trend that once followed through may now stall quickly. Volatility may have expanded. Leadership may have narrowed. Reactions to news may have changed. When those surrounding conditions shift, the same setup can produce very different behavior. The trap is familiarity. Because you recognize the pattern, you expect the old response. Then, when the market behaves differently, you blame the individual trade instead of questioning whether the environment itself has changed. Watch what happens after familiar signals appear. Are breakouts holding or failing? Are trends extending or reversing sooner? Are strong names still being rewarded? Or is strength being sold? These observations tell you whether the market is still supporting the assumptions beneath your method. A setup should earn trust from present conditions, not from its reputation in a different market. When repeated trades stop behaving as expected, the question is not immediately whether the setup has become useless. The more useful question is whether the market has changed the rules under which that setup once made sense. And if conditions begin favoring you again, a different danger appears. Profit itself can make risk feel less serious than it is. A profitable position can become dangerous when the gain starts to feel less real than the money you began with. Once a trade moves well in your favor, the mind often creates a false cushion. A portion of the open profit starts to feel expendable. You allow more room, tolerate weaker behavior, or accept additional risk because giving back some of the gain seems different from losing capital. But the market recognizes no such distinction. An unrealized profit that remains exposed is still part of what can be lost. If you would not accept a certain amount of risk from a fresh position, you should question why the same risk becomes acceptable simply because the trade is already ahead. This is where open profit can quietly change your standards. You stop asking what the current position deserves and begin measuring decisions against the highest number you recently saw on the screen. The gain becomes permission. A useful test is to imagine the current profit did not exist. Looking only at the position as it stands now, would you still accept the same exposure and the same potential giveback? If not, then the cushion is influencing your judgment more than the market is. Profit should improve your position, not weaken your discipline toward it. And once a trader becomes comfortable using existing gains to justify more exposure, the next temptation often appears when price moves the other way, adding more because a lower price seems to make the trade cheaper. A lower price can make a losing trade look more attractive at the exact moment your exposure is becoming more dangerous. That is the seduction of averaging down. You buy again below your first entry, and the average cost improves. Now price does not need to recover as far for the position to reach breakeven. On the screen, the trade appears easier to rescue, but the account is carrying more of the same uncertainty. The important fact is not that your average price improved. It is that you committed additional capital to an idea the market has not yet rewarded. A better cost basis can therefore create a comforting picture while total risk quietly expands. Before adding, remove the original position from your mind. Imagine you own nothing. At this exact price, with the market behaving exactly as it is now, would you initiate the larger position you are about to create? If the answer is no, then the addition may not be a new decision at all. It may be an attempt to repair the first one. That distinction matters because adding should require fresh justification, not merely a cheaper price. Lower prices can improve an opportunity, but they can also reflect worsening conditions. The price alone cannot tell you which one you are facing, and that leads to the next problem. Even when your market idea is sound, committing capital before the market begins to confirm it can create an entirely different kind of risk. Being right about direction does not mean you are right about timing. You can see a market that looks ready to move, understand the larger logic, and still enter before price begins to confirm your idea. That early entry feels intelligent because you are trying to act before everyone else. But anticipation creates a cost. You begin paying for a move that has not started. The longer nothing happens, the more your thesis begins consuming attention. Small fluctuations become meaningful because you are already exposed. You start defending an idea that might eventually prove correct, while capital remains committed to a market that has not yet agreed with you. That is why a thesis and a trade are not the same thing. Before entering, decide what observable behavior would show that the market is beginning to act in the direction you expect. It might be a level holding, resistance giving way, momentum appearing, or selling pressure failing. The exact signal matters less than having one. Ask yourself, what evidence must appear before this idea deserves capital rather than observation? Waiting for confirmation does not remove uncertainty, and it does not guarantee better outcomes. It simply forces the market to contribute something before you commit. Because once money is involved, patience becomes harder and judgment becomes easier to distort. And that is why some of the most important risk decisions should be made before the position has any chance to argue with you.